John Culbertson, interest rates are going to remain low for the foreseeable future, no matter when the Fed finally pulls the trigger. So what else can monetary policy do? Is that all there is?
It's a great question, Greg. The problem is no one's really sure what happens when we reach the end of the effectiveness of monetary policy. Interest rates are already very low. You're right, they're going to probably remain low, even if the Fed raises rates in the short term. But the question is, why are they low? They're low because we're probably in a secular disinflationary cycle. If monetary policy has run the end of its course and it's no longer useful, then there's a big question of what happens next. Bank of Japan is probably an indication of what could happen next, which is potentially buying risk assets. Hard to imagine the Fed doing that, but could there be a QE4 or QE5? Who knows?
Well, is there too much debt in the system? Because as rates have remained low, corporations, governments have really raised a whole lot of money. Is there another danger lurking out there?
Well, corporations are just doing what's best for their balance sheets in the short term, which is to optimize their cost of capital. And that has included issuing a lot more debt and buying their stock back, which in the short term makes a lot of economic sense. In the long term, I think the question that you're asking is absolutely the right one. Can that debt be serviced when the profit cycle begins to peak and turn down? That will be the challenge, because in terms of absolute dollars, yes, we are reaching peaks in the amount of leverage on corporate balance sheets.
So, for example, we're seeing spreads widen in the high yield sector. We haven't seen a lot of defaults yet. We haven't seen that rate spike, but will we start seeing that maybe in the coming year? And will that be the canary in the coal mine?
That's exactly right. So if we are indeed peaking in the cycle of profits and we are going into a slower growth phase, then those spreads would continue to widen and we would see defaults pick up. But there's a scenario where we could just grow at 1.5% or 2% for several more years and slowly grow our way out of it. But most likely, the spread widening that we've seen is an indication that people are nervous that these companies will not be able to service that debt as expected.
All right, so I've laid out a few doomsday scenarios. What's your view? Will we see cracking in the high yield market, and will that lead to greater problems in the fixed income world?
It's really hard to say. My suspicion is that the central banks will continue to do what they've done for the past 6 years, which is systematically suppress volatility, do everything they can with monetary policy to extend the expansion cycle as long as they can to allow balance sheets to continue to repair themselves. The problem is, this has to end one way, and it can either end quietly, where we grow our way out of this globally, or it can end poorly. It can end badly, with a bang, if you will. And my guess is most likely the markets will push back on the systematic volatility suppression we've seen, and we will have another downturn, probably driven by lack of growth in the global economy.
Well, you run a macro strategy over at Context. So which strategies are working best for you right now?
We try to employ strategies that have asymmetric payoffs in an environment that is adverse to risk assets. So we build a portfolio that has embedded optionality in it. And that's really difficult, complicated to do. But we think a strategy that should perform modestly in a low volatility environment, but be very low correlation to risk assets. But in a stress scenario, an adverse market scenario, strategies that have that asymmetric payoff can be really valuable in a client's portfolio, and as a negative correlation to the markets. So that's the approach of this fund, the Context Macro Opportunities Fund.
So where are you finding those asymmetrical opportunities right now? Is it in currencies, interest rates? Because there's a lot of strategies out there in macro world.
Yeah, it's mostly...
I've heard a lot of big hedges out there. They're having some problems with the macro world.
It's been very difficult given the lack of persistent volatility in the market and the fact that central banks are doing their best to suppress volatility. We're finding some opportunities in fixed income, mostly relative value trades. Trades that will perform well if spreads continue to widen, for example. But we are positioned very modestly. We're in a wait-and-see mode.
All right, and then finally, what about the average investor out there? What should they be doing with their fixed income portion of their portfolio? Should they run for the exits now because bad things are coming? Or should they hang on because, look, we've seen Treasury prices move up?
We have. It's a great question. First, they should talk to their financial advisor. These problems, I think, are very complex, and I think they may be unprecedented. in an environment where the coupon cushion that you receive in your fixed income portfolio does not provide a lot of protection. So therefore, it looks like bonds as an asset class may be fully valued unless we're in a dramatically deflationary environment with a 2% 10-year and a 0% Treasury bill. In the same sense, equities look to be like they're fully valued, if depending on what type of metric you use. So the key is going to be really being thoughtful about diversification. What other assets will provide diversification? Not in a low volatility, grinding environment that like we've seen, but in an extreme environment. And those assets are difficult to find. Fixed income will not provide that for you. Credit will not provide that for you. You've seen commodities will probably not provide that for a traditional portfolio. So we think moving to strategies that are explicitly designed to provide diversification, like discretionary macro, systematic macro, CTA strategies, that had traditionally have done well in times of that have been adverse to risk assets. We think they're the strategies that will be the true diversifiers.
All right. Well, thanks a lot, John.
Thank you, Craig.
Thank you for watching The Street.